So these are the 2010 tax brackets, and these are, again, paid on taxable income. So not on gross income, not on adjusted gross. Page 2 of the 1040, about a third of the way down, taxable income. And what you can see here is at the lower income brackets, the 10 and 15, basically you take the single, you double it, you get married, filing, joint. You take the single, double it, you get married, filing, joint. What about the other brackets? You take 82.4 and double it, that does not equal 137. So essentially there's kind of a marriage, a penalty for a single person here. And if you think about it, it's pretty easy to get over $34,000 and up into that 25% tax bracket if you're single. And so if you're married and you pass and you leave along a traditional IRA and you add in Social Security and some other income, it's very easy for your surviving spouse to go ahead and get bumped up into this 25% tax bracket. If you converted those funds into a Roth IRA and you pull that money out, it's not taxable. So it's more likely that you can probably stay in that lower tax rate. Something I haven't seen many people talk about that in the press and what have you, but it's certainly something that's there. It's hard to quantify that. You know, who knows when one spouse is going to pass and what have you, but that's the way it is, and you can see as you move up, the tax rates essentially become identical. So just to recap, what are the critical decision factors when you're kind of doing this analysis? The tax rate differential. So the year of the conversion versus the year of the withdrawal. And again, that may be over your lifetime for income purposes. That may be your surviving spouse taking it out, or that may be leave-on money and leaving it to your kids or to your grandkids. So that differential is really a big factor. And we don't know what the differential is going to be because we can't predict the future. But if we're no better or no worse off day one in terms of purchasing power, by all means, I think it makes sense to kind of hedge some of that risk. Use of outside funds to pay the income tax liability, big factor. So we really do need some money outside of the account, outside of the retirement accounts to pay the tax to make this thing really work well. Need for IRA funds to meet annual living expenses. Again, the more you can let this, another way to say this is time horizon. The longer you leave that money in the account, the better the Roth IRA and the Roth IRA conversion becomes. Again, it's not, you don't have to have 20 years, but the longer that it is in there and the longer that it is deferred, the better it's going to be. Tax rate differentials are key. So if you think about it, when you look at the tax brackets, going from a 10 to a 15 to a 25, 28, 33, and 35. The way that I think about it, and pictures always help, but there's a big jump from 15 to 25, isn't there? Very small jump, or 3%, as Larry said. 28 to 33, a little bit of a bigger jump, and then again 20 to 35. So we even showed in that first example, moving from a 25 to 28 was still beneficial. I'm not too crazy about going from a 15 into a 25, unless we know later on down the road that we're definitely going to be in a higher tax rate, and higher tax bracket, and that does happen for some people, especially depending on when they retire. And if you have a lot of money outside of retirement accounts, typically we spend those dollars down first, and some of those funds, when you do spend them down, have already been taxed. So it's just a tax-free return of your basis, essentially. So it's very possible for some very high income people to be in a very low tax bracket as soon as they retire. But the traditional advice is, well, that's great, let's go ahead and have a party. And what I would say instead is, well, maybe we should go ahead and use some of those low tax rates to go ahead and convert today to hedge our risk going on down the road. Window of opportunity. So again, one way to think about this is, and this is really why you can't look at this in a vacuum. It really has to be part of the financial plan, or what are we trying to accomplish, and then what's the best way to do it. But some of the things, let's say that well, first of all, each and every year, basically we have, say if you're married filing joint, you have 2 personal exemptions. So you get to deduct $36.50, I think it's what the number is this year, from your taxes, just for you being you. So a little bit more than $7,000 when you add those up for husband and wife. You also get a standard deduction if you do not itemize, which is $11,400. And then I think it's after over age 65 you get a little bit more. If you have itemized deductions, charity, and that's another tax planning opportunity. If we want to make a large deduction or a large donation to charity, so we have a big charitable deduction. You know, if we don't have enough income, we may not be able to utilize all that, so it may have to be carried forward. But we can kind of incorporate that into our conversion strategy. But you know, each year, say we're 62, and let's say we have our retirement assets and some non-retirement assets. So typically, we want to spend the non-retirement assets first. There could be some exceptions to that, but generally that's the rule of thumb. If you have a pension, typically the normal, what they call the normal retirement date is age 65. You may have some, you know, a lower date if you have 30 years of service or something like that. Every pension plan is different, but typically it's age 65. We can choose to defer Social Security, and as many of you have known, as we've kind of showed through the retirement planning that we've done, it often makes sense to defer Social Security at age 70. And by doing that, it also makes this window a little bit wider from, you know, the pre-70.5 window. Because after we get to age 70.5, or the year after the year you turn 70.5, we lose a lot of that flexibility. It doesn't necessarily mean that you don't want to do any sort of conversion post 70.5. We've already shown that isn't the case. But essentially, you lose some of the flexibility that we have. So really, in my mind, and for a lot of you that we're already doing these conversions for, you know, you have this about, call it a 10-year window from depending on the time when you retire to when we get to the age of 70.5, that we have a lot of flexibility. And we can kind of create, through tax planning, through the timing of Social Security, through the timing of pensions, or how we're going to take the pensions, whether it's a single life or whether it's a survivor-based pension. We have a lot of tools in the tool belt to kind of mitigate the taxes and potentially tie that into a conversion strategy. So flexibility is good, tools in the tool belt are good. Recharacterization. Heads you win, tails you get a do-over. Doesn't happen very often in the tax code. So this is what I was talking about. It's called recharacterization. And what is it exactly? You may recharacterize or undo the Roth IRA conversion in the current year. So if we converted, say, January 1 of this year, and we're in July, and you know, we go back into recession and the market goes down, and when we converted it, it was $100,000, and now in July 1st it's $75,000. Well, I'd rather pay tax on $75,000 than $100,000, right? So you can kind of go back and undo that. Not kind of, you can. Recharacterization can take place as late as 10/15 in the year following the year of conversion. So essentially, we have all the way from, if we do that conversion January 1st of 2010, we have all the way through October 15, 2011 to figure out, well, do we want to keep it? It's kind of like test driving a car for, you know, almost 2 years, if you will. And, you know, heads we win, tails we get a do-over. Kind of like it's similar to what the Wall Street banks get, you know, heads they win, tails we all get screwed. We won't be screwing anybody else. Taxpayers may choose to reconvert their recharacterization. So you have to wait a little while.
What?
Yeah. You can go back. You can do a tremendous planning opportunity, but it is very quickly the complexities involved in this stuff. I mean, for us, we've had to set up procedures just to make sure that the record keeping and all these things are done very, very well, because the details on this are tremendous. And each conversion has its own set of books, if you will. So you have to have very, very detailed records here.